You feel it. Every month. The new mortgage payment. The auto loan quote that makes you wince. The credit card statement where the interest charge has its own line. Who decided this? Who's actually setting this number? Your local banker? The president? A secret council in a marble building? Let's follow the money. And the answer might not be who you think. Here's the phrase we all hear. The Fed raised interest rates. So the myth is that the Federal Reserve, that big building in Washington, sits there dialing in your 30-year mortgage like a thermostat. Here's the reality. The Fed sets one single ultra-short-term rate. It's called the federal funds rate. It's a target rate for banks lending to each other overnight. Think of it as the Fed's official suggestion box, but the rates that actually matter for your life. The 30-year mortgage, the 10-year car loan, the business loan, those are decided in a global trillion-dollar, 24-hour auction called the bond market. That's the shocking truth. The Fed whispers a suggestion, but the bond market shouts the price. And that shout is what becomes your interest rate. So who's really on this rate-setting committee? Let's meet the key players. First, the official voters. The Federal Open Market Committee, FOMC. This is the Fed's board. They meet, they vote on that one suggestion box rate. They're trying to steer the economy by making money cheaper or more expensive to borrow. Second, the real power brokers, the bond vigilantes. This isn't an official group. It's the nickname for global investors' pension funds, foreign governments, hedge funds. They vote with trillions of dollars. If they think inflation is too high, they demand higher interest rates on bonds. If they're worried, they demand even higher ones. The market listens. And third, the final markup. Your bank. They take the market's rate, then add their own layer for profit, for their costs, and for the risk they think you, specifically, pose. That's the final markup to get to the APR on your screen. So how does this abstract game of global hot potato translate to your loan? Anxiety. When that inflation report comes in hot, the bond vigilantes get nervous. They demand higher rates to protect their money. Mortgage rates jump. Global craving. When the world gets scary, everyone wants ultra-safe US debt. High demand lets the US pay lower rates. That can help keep some of our rates lower. Local competition. This is your leverage. When banks compete for your good credit, that final markup gets smaller. You have a seat at this table too. Knowing this isn't about finding a villain to blame. It's about replacing mystery with understanding. Think of it like this. Before you plant a garden, you need to understand the weather system. Not just what the weatherman suggests, but the real pressures, the jet stream, the seasons. You just got a lesson in the financial weather system. You now know the real forecast for where rates come from. So the next time you see a headline about rates, you won't see a mysterious force. You'll see a global auction, a reaction to inflation, and a competitive market. And with that knowledge, you can plan your financial life. When to borrow, when to wait, how to shop around. Not with anxiety, but with insight. You've got this. Subscribe for more financial clarity.